I think at one level, the Fed today would say that the pre-crisis Fed of 2006, 2007, and the first half of 2008 was asleep at the switch and neglected things that they should have been, jumping on. So the Fed today, I would call hyper proactive.
Hello again, everyone. Welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Today, I'm joined by Keith Weiner. Keith is the CEO and founder of Monetary Metals. So, Keith, I'd like to welcome you to my home. And how are you doing?
Doing good. Good to be here in Singapore.
Glad to have you back over again for another interview. Keith, when I was researching some topics that we could talk about for this interview, I came across this website, keithweinereconomics.com. Do you know anything about this?
Yeah, there's some guy who looks like me with my name has some similar ideas. That's my site. That's my personal site where I post stuff that, it's economic related, but not necessarily monetary, not necessarily, strictly in keeping with the theme at monetarymetals.com. So, gives me a place to put my writings when I get them use.
One topic that is on people's minds right now are we saw the Fed leaving the Fed funds rate unchanged. What's your opinion on this?
Well, that's a topic and a half. We did on our podcast, it was October, it must have been 2021, because it was before the Fed rate hikes. And, in honor of Halloween, we called it Zombie Month. And, it was all about the Bank for International Settlements defines a zombie company as a company whose profits are less than their interest expense, which is, since the only way to pay interest is out of profits, that puts them in a really bad situation. And so at zero interest rates, um, something like 20% of all corporate debt outstanding was zombie debt. That was at zero. Now we've hiked where the Fed funds rate is over 5%. And, corporations, of course, are not borrowing at the T-bill rate. They're borrowing at a spread to that. So corporations are probably borrowing at, especially if you're a zombie, you're junk rated probably, I don't know, 8 or 9% or something.
Yeah.
How many more firms are zombie at 5.5% Fed funds rate versus zero Fed funds rate? Well, I haven't seen any data yet, but that's the problem with higher interest rates. When you make, every business has a certain amount of invested capital, and you can calculate your return on invested capital. When the interest rate in the market is above the return on capital, you are non-viable. You either find some clever way to get your return on capital up, or ultimately you're headed for liquidation and shutdown. And we're in a world where, man, there's an awful lot of that is coming. And I think the Fed would be aware of that. I mean, just look at commercial real estate.
Yeah.
I saw some headline 2 or 3 weeks ago that caught my attention. There's over $2 trillion of write-down so far in commercial real estate. And, that's obviously a problem for borrowers, but it's a problem for the banks. When the borrower says, okay, here, Mr. Bank, take the keys back. We're absolved of all this. What is the bank going to do? It's not like there's a market that's going to revalue it higher. In most cases, when the developer fails and gives it back to the bank, it's not because the developer were a bunch of incompetent idiots. It's because the market for commercial real estate has changed, post-COVID. So there's a lot of this going on, and I think the Fed internally would have to be aware of this kind of stuff and very eyeing it nervously.
Yeah, I mean, surely they have to be. I mean, you got Jerome Powell, head of the Fed, and you have Janet Yellen. She's a Treasury Secretary. She was also head of the Fed. I mean, you would think these, especially these two, they could clearly see things and the path we're on. Yellen has pulled back a bit. She said, she kind of regrets in a way using that word transitory, where she said inflation was transitory. I mean, what's your take on this? Because I think most of us generally knew that it was not going to be transitory the way she was trying to make it out to be.
So I've got a different take on a lot of issues, and consumer prices is one of them. Um, I feel like it's my view versus pretty much everybody else in the entire world, both the people who are at the Fed, the people who apologize and defend the Fed, and the people who are its most strident critics, pretty much all agree on the quantity theory of money. And I don't. So I don't think it's true that an increase in the quantity of dollars causes an increase in the price level. Um, I think what happened, um, in the wake of COVID, is several large non-monetary forces. Let's call them the non-monetary elephants in the room. The first is lockdown. I mean, lockdown destroyed enormous amounts of productive capacity. That shut down everything from meat plants to obviously shipping, logistics, freight forwarding. I mean, that entire industry, the ports, the harbors were just decimated initially. Um, and just across the board. Then unlock, um, there was this incredible whiplash where suddenly everybody was supposed to go back to work. Well, firms that failed obviously don't. And a lot of these guys, I saw it with the airlines. If you were flying in, let's say, 2022, what you ran into was there was a lot of demand. There was like a whiplash demand for air travel because everybody had been pent up, cooped up for so long. But the airlines had fired so many people. And then when you come back after a couple of years and say, hey, Patrick, I'd like to give you your job back, you find that this guy, Patrick, has moved to another city. He's working in another industry. You can't bring your old staff back. So they're bringing new people on. So they'd lost so much institutional knowledge of how to work the processes and systems within the airline that bags were being lost and flights were being delayed. I mean, it was just a logistics disaster. Well, the same thing happened with shipping, for consumer goods. The whiplash, was almost as bad, or in some cases worse than the lockdown. Then, on top of that, you had tariffs and trade war, where tariffs, obviously, if you throw a 25% tariff on imported Chinese steel, but it wasn't just China. The U.S. threw tariffs on Canadian imported lumber and Scotch imported, Scottish imported whiskey and all kinds of things got tariffed. And obviously that drives all those prices up. But trade war is broader than that. I mean, if you're a semiconductor manufacturing company and you have facilities in China, you'd have to be thinking it's time for us to build redundant capacity, either in the US or what they call nearshore, Mexico or something else. Now, if you were in China, that's because that was your best jurisdiction. Now you're building something that's not your best jurisdiction. The reason why it's not your best is more expensive. So not only are they obliged to come up with tens of billions of dollars in capital to invest, I mean, semiconductors is very capital intensive, um, but they're manufacturing in higher cost jurisdictions. So all of that and the tariffs and everything else, we'll call it tariffs and trade wars. Thirdly is green energy restrictions. So when and this hits Europe much, much worse than in America. So let me put this in perspective. I was traveling last summer, um, and as I blogged about on keithwinneconomics.com and all the different places that I went. And to compare America to Europe to, let's say, Dubai, just from an energy consumption perspective. In America, when you went to big public, buildings, let's say airports, the air conditioning was normal as what you'd expect. And, they had air conditioning and it is what it is. It's what's always been. In Europe, it's like they've turned off the air conditioning in the airports. In, in October in Barcelona, where it's not exactly that hot, the airport was sweltering. I don't think there was no air conditioning going on. In Dubai, they was extremely hot and humid. A lot of hotels kind of organized around a central courtyard, which is an outdoor space, and they put some sunshades over it. But it's an outdoor space. Um, they have more, portable air conditioners on wheels that they roll in all the way around the entire courtyard. Air conditioner units blowing cold air. Yes, they're air conditioning outdoor spaces in Dubai. So in Dubai, energy is cheap. In America, it's not as cheap, but not that expensive. And in Europe, it's become very expensive because of all the green energy restrictions. Um, so when the price of energy skyrockets, then the cost of everything that's produced with energy or distributed with energy can skyrocket. This is not monetary in origin, and yet the effects are massive. So in the UK, where I have some data, the price of natural gas went up 15 times what it was. It was so bad that fertilizer manufacturers, so they manufacture certain fertilizers using natural gas, shut their plants. They couldn't, be in business. Um, so this had a ripple effect on food, which is not only energy intensive to produce, but energy intensive to distribute and process. Has to be refrigerated in many cases, um, and everything else from heating and cooling in hotels and stores and restaurants to cooking in restaurants to everything just absolutely skyrocketing. This is not monetary in nature.
Yeah.
Finally, you had Ukraine, that war. Now, President Biden, being very disingenuous and trying to blame all the rise in price just on Ukraine, and everybody, rightfully called him out and said, "You idiot, that's not true." Um, but that certainly contributed. Ukraine is one of the world's was I don't think anymore one of the world's biggest producers of wheat, and there's certain other things coming out of Ukraine as well, or used to come out of Ukraine that don't anymore. Plus, a lot of Russian capacity went offline. So, and then on the fiscal side, which isn't monetary, I don't know how it is here in Singapore, but in the U.S., there was a moratorium on evictions. So if somebody was renting from a landlord and didn't pay the rent, it was illegal for a certain period to evict them. And so obviously a lot of people didn't pay the rent. I mean, you don't have to, right? So between not paying the rent, not paying the student loans, some stimmy checks, which is fiscal, not monetary, there's an awful lot of people who decided, why should I bother working? I basically can now live the lifestyle I had before without working. Why should I work? And so, certainly, let's say you're talking restaurants, but a lot of, labor intensive, either unskilled or semi skilled work, suddenly there are no workers. And you had to bid up the price of labor
Yeah.
to, if the wage had been in Arizona, let's say $10 an hour before COVID, you're paying $25 an hour post COVID just to attract the workforce. All of these things had massive effect on consumer prices. And in that sense, I think that largely is transitory. I don't expect that's going to continue, like they're going to double down and make it twice as bad next year as this year. However, what they did was they hiked the interest rate, because that's what the mainstream theory calls for. It's about controlling the quantity of dollars, since the quantity of dollars is the only possible cause for rising prices. Not true, but that's the mainstream theory. You have to hike the interest rate. What does hiking the interest rate do? It means that every business whose cost of capital is now, or excuse me, a return on capital is below the new market interest rate or the cost of capital, has to be liquidated. That at the end of the day, so I wrote an article that my marketing team gave the headline, Keith Weiner's macro equation. That wasn't the headline I gave up, but okay. And I said R is greater than I. Return on capital must be greater than interest rate or cost of capital. You can't borrow at 10% for a hamburger restaurant that makes 8% return on capital. That's a guaranteed, you can lose money until you go out of business. So by hiking the interest rate, you've gone to all these businesses that were profitable, had a return on capital greater than the cost of capital, and you've rendered them sub-marginal. So you've raised the bar. It's like raising the minimum wage. So let's say the minimum wage is $7 an hour, and there's all sorts of people that are employable at 7 or 7.50 or 8, and you raise the minimum wage to 15. You're not giving all those people a boost. You're just raising the threshold, you're cutting them off. Now, they're drowning underwater. So they've done that now with return on capital. And the only way, only two ways this can be resolved. And I talk about this in the 2024 Gold Outlook report that we just published. One is such massive liquidations, right? So how do you get, how does return on capital go up? Well, let's say you take the industry of hamburger restaurants. It's a combination of you and all your competitors. Enough restaurants have to close and declare bankruptcy. And of course, there's mass layoffs occurring through all this, and huge amounts of stress on bank balance sheets, which is causing massive credit stress everywhere. So demand is going to be falling like a brick. But supply has to fall even more and even faster, such that what's left, if there's 50 hamburger restaurants, the one surviving hamburger restaurant after the other 49 are destroyed, would finally have enough pricing power to set their price high enough that they can get a return on capital greater than for whatever demand is left, which would also be collapsed. So demand falls by 97%, or and supply falls by 98%, um, then you finally have enough pricing power to charge high enough prices that you get a return on capital greater than the new interest rate. So um, by raising interest rates, they've got the sign wrong. They've actually moved in the opposite direction. And I'm not an advocate of low interest rates or falling interest rates. I think there are many harms to doing that, of which I've written many, probably hundreds of thousands of words on all the harms of setting interest rates too low. But if one were to ignore those harms and focus only on consumer prices, one should want lower interest rates, not higher interest rates. And in the wake of lockdown and whiplash, what we need is more companies to go into capital intensive industries like shipping and logistics. And by hiking the cost of financing those businesses, we've said, don't bother setting up these new businesses. Don't bother replacing the capital that was destroyed because you can't make enough money to service the debt. So if you already have the debt and you already have the business, you'll struggle through. If you are considering making the investment and you're not in there yet, obviously you're not going to do that. And so what they've done is the opposite of what they say they intend to do. So we'll see how long that lasts. Or the other thing that could happen, short of this crisis and all this mass liquidations, uh, is the Fed could reverse itself and slam the interest rate right back to zero.
Mm.
And I think, leaving aside of which would be more harmful, I think there's no political will to go through that kind of crisis and that much layoffs and liquidations. So when the crisis really gets rolling, that it's pretty clear what they're going to do.
Okay, that's pretty interesting what you said, because when you had mentioned there's fiscal policy, there's monetary policy, and then you threw in another one, sanctions. How sanctions can also have an effect on the prices of things, causing inflation. And so that kind of took me to Japan, where a few days back it just raised its interest rate. It completed its negative interest rate experiment, and it's raised the rate. So I'm kind of wondering here, do you think maybe this long bout of sanctions could be one reason where Japan is seeing inflation now and they've decided to up their interest rates?
Yeah, I haven't. I've been on an airplane a lot in the last few weeks. I haven't really had a chance to read what Japan said about all this. But yeah, I'd imagine they're looking at inflation and saying, okay, hike the interest rate because that's what the standard playbook says to do. Now, Japan has had zero interest rates for so long, zero and negative for so long, that by hiking them now, it should be more obvious to them than it is to the Fed. You're just going to cause liquidations. And do they have any political appetite for that? I don't know. Um, we'll see. And now with the Fed saying, hey, we're not ready to cut yet, but we're clearly going to cut. For Japan now to say we're going to hike just seems, Johnny come lately to the party.
Yeah, that's another point there, because I wanted to ask you if you thought the has the Fed fallen behind the curve, or are they maybe a little bit too slow to react, or really is this such a delicate situation right now that things have to be painstakingly scrutinized before any move is undertaken?
You know, I could answer that at several levels. I think at one level, the Fed today would say that the pre-crisis Fed of 2006, 2007, and the first half of 2008 was asleep at the switch and neglected things that they should have been, jumping on. So the Fed today, I would call hyper proactive.
Mm.
They're absolutely looking at everything, and which is why they've already, even late last year, signaled there'll be some rate cuts this year, as I think they're looking at that. But in a certain sense, right? And this, I mean, there's a lot of things I say that are controversial and
That's
new,
why we like you.
but this, what I'm about to say, isn't. Certainly, many Austrian economists, Hayek and Mises to name two, um, are for over a century have been saying central planning is not possible. It's not possible to get it right. They don't know what they need to know. There's no way for them to know it. There's no way for them to act on it. And I actually add to that and say, and even if they somehow magically got the right price, the mechanism by which that price works isn't what would happen in the market anyway. So the outcome is different, even if it dictates the right price temporarily. Um, and so, what are they supposed to do? I mean, Zero interest rates is enormously destructive. Nobody, and I spent a lot of years writing about all the destruction being wreaked by it. Nobody should sit here and say, let's have zero interest rates. On the other hand, hiking interest rates is going to be destructive. I like to use an analogy of a wrecking ball. So you have a city street, and the wrecking ball goes to one side of the street. Let's say it's the falling interest rate, so it's the south side of the street, and it's messing around over here, and all these buildings are just getting banged in, and bricks are flying, the things are caving and floors are collapsing. And then, oh, let's go to a hiking rate structure. Well, now the ball swings to the north side of the street. It doesn't repair anything over here. Everything you've destroyed over here still looks like a bombed out ruin. Now we're just doing it to the buildings on the other side of the street. And there isn't really a right answer. You can't get this right. And the root of the problem, and this gets back to why you and I are both in the precious metals business, is that you need an honest monetary system. If you um, excommunicate, um, you know, money from the monetary system, and by money, let's just call it the extinguisher of debt, which is what gold is. If I owe you money and I pay you in Federal Reserve notes, I'm paying you a credit. I'm paying you an IOU. The debt doesn't go out of existence; it just shifts around, and so the debt grows exponentially, which is exactly what's happened since Nixon expelled gold from the monetary system in 1971. If I pay you in gold, the debt is extinguished. So we have no extinguisher of debt, which means the debt is growing exponentially. Necessarily, this is a feature, not a bug. It's not, well, Congress doesn't have fiscal discipline, which they don't, but that's not the root of it. The root of it is the monetary system works the way it works. It's wired the way it's wired. And within this monetary system, there is not only is there no way for the Fed to set the right interest rate, there is no stable right interest rate anyway. And the system grinds inexorably towards, um, a failure at the end. The question is, do you want the failure now or do you want it later? Mises writes about this, the crack of boom. Um, so, anyway, so that's my deeper answer to your question about, is the Fed, reacting too slow? What are they doing? There isn't anything good they could do, really. I mean, it's just a matter of managing, the decline and failure of it. And do you want to draw it out or do you want to blow it all up all at once?
Okay, and so with all of this, central banks have been buying up gold. They have been buying up gold for the past few years. They continue to buy gold. What's your reason why you think central banks are buying gold? I mean, we talk about a sound money system, but I'm not so sure if that's what it'll be. Is it more about the Fed just trying to retain some assets or their value on their assets?
Well, the Fed isn't buying gold, but
I mean, sorry,
the
the
other
central
central
bank.
banks.
Right.
Um, I mean, a couple of things. The obvious one is I think the price of gold is likely to go up. And, the neat thing about, uh, if you're in a world where everything is sort of turning to ruin and you can buy whatever asset's going up, it can recapitalize you no matter how deep trouble you're in. If you buy the right asset and it goes up enough, suddenly you're solvent again. And I think everybody's looking at. So one thing that's worth saying, I think we're not in the the incredible bear market of second half of 2011, right? So the gold price peaked August of 2011, if I recall, and then it's been a hell of a bear market from that point through 2018, 2019, depending on how you draw it. We're not in that bear market. We're in a bull market. And there'll be zigs and zags, and right now, obviously, we're on a big zig, and everybody's pretty happy about that. Um, but it's pretty clear to people that are observing the market that this is a buy the dips market versus the sell the blips market that we're in for all those years. And so that's one thing. Another is, outside the U.S., even for countries that are friendly to the U.S., the dollar is doing them no favors, and they get it. And everybody would like to have an alternative. Tina, there is no alternative. There's no other paper currency that can remotely come close to replacing the dollar. They're all dollar derivatives anyway, so that's just kind of bizarre. It's like, well, we don't like Apple shares anymore, but we're going to trade Apple call options because we think Apple shares are going to go to zero. Well, obviously, if Apple shares go to zero, the call options would go to zero first.
Yeah.
But gold is the one thing they could. Now, the irony to the whole thing, so they're looking for an alternative to the dollar. They're not happy with the dollar, not happy with the U.S. government necessarily, or its monetary policy for sure. This rate hike has caused enormous dislocations in the rest of the world that Americans can't really, quite grasp. But there's one thing that we can also be sure of is there is no government in the world that wants a gold standard. I mean, even Javier Milei, and I'm very reluctant to criticize him because it looks like he's doing a lot of good things, so I regard him as an ally. But when it comes to fixing Argentina's monetary system, did he say gold standard, or did he say we're going to not de-dollarize, mind you, for everyone's thinking this is all about de-dollarization. He's talking about dollarizing, and all of his advisors, all of the sound money people and the smart people in the room are saying dollarize, not goldize, dollarize. So whoever's buying gold, they're not buying it because they think there's going to be a gold standard or want there to be. They don't want a gold standard.
Right.
I don't know about Javier Milei personally. He might be very receptive to a gold standard, but it's possible that he has advisors that are just saying there's no way that a gold standard is going to fly politically. So there's obviously, he's a politician and he has to make that political calculus that as an economist, I can sit here and say, yeah, we should all go to gold. And he has to deal with things like voters and his legislature and all kinds of other practical considerations. But he's dollarizing, he's not goldizing.
Right.
And so I think they see it as a diversification play. They may see it as a de-risking play. They see it as something where the price of gold is likely to go up, which recapitalizes them. Um, and that's why they're doing it.
Okay. Yeah, true. There are politicians, they and they do not want any type of sound money. Definitely, they don't want gold. But from where you sit, you speak to a lot of investors. Are you seeing more of investors looking at buying gold, more of a curiosity of why gold?
So in general, so monetary metals customers are increasing their allocations to gold because if gold is a costing asset, you only want to hold a certain amount. But we make it a yielding asset that pays. So of course it makes sense to increase. So we're kind of reversing the trend. But for the most part in the Western world, um, so not just the U.S. and Canada, but let's say Western Europe, to a lesser degree, let's say Germany and Austria, because they have a lot more eastward-facing contact and more awareness of it. Um, you know, Australia, New Zealand, um, there is not right now a lot of buying of metal. The market is pretty moribund. Certainly at the retail level. I mean, hedge funds may be a different story. Um, but all through the West, I mean, you talk to dealers and it's a trying time right now. And yet the price is not only holding up, but it's making record highs as we're talking. Um, so it's a record high in US dollar terms, let alone in other currencies, which have been falling against the dollar for years. Um, and so in Japanese yen, I'm sure there's a major, if you look at the price of gold in yen, it's much, much more dramatically rising than
Yeah.
in US dollar terms. Um, but, in the East, so let's just take, the three worlds that are kind of bridged, by Dubai. So you have the Arab world, you have the Turkish world, and you have the Indian world. All three, and then you have China. The Chinese are also buying within the limitations that China limits the amount of gold they can import. So the price of gold within China is much higher than the price of gold, at least the last time I'd seen outside of China, simply as a function of they restrict the imports. You can't arbitrage it and buy gold in London at that price and sell it in Shanghai at a higher price. Um, so people in four countries are buying gold, but I think for largely different reasons, right? So in the Arab world, actually let me start with India first, and then Turkey, and then the Arab world, and then China. In India, it's not hyperinflation there, but the rupee is a low quality currency that nobody really trusts. I mean, the Indians don't really think of it for savings. They trust gold, and so they always want to buy gold. And the only thing that really limits that is whether they have the disposable income to do so. So when the monsoon is poor and the crop harvest is poor, they simply can't afford to buy the gold that they want to buy. When things are going better, then they're always buying gold. And right now they're buying. Um, Now the rupee, I think I saw the average is it loses 7% against the dollar every year. and
Okay.
the dollar is supposed to go down to 2% a year. That's the Fed's, you know,
Inflation target.
preserve its purchasing power. I mean, Orwell would be spinning in his grave to see this, that the Fed is charged with maintaining the purchasing power of the dollar, stabilizing purchase, something like that. And their policy is 2%, relentless forever. And the rupee is going down 7% against that. Um, in Turkey, it's potentially incipient hyperinflation. I mean, the Turkish lira is really in trouble. And so, having been at the bazaar in Istanbul, this famous market that's been there for I don't know how many centuries or millennia, um, I can tell you that I saw probably at least 100 little gold shops,
Wow.
just dealing in, gold. I'm told, because I had a Turkish guide who took me around, I'm told that there's a lot more gold shops, and a lot less textiles and spices and other things. But I did see some Iranian spices, like they had a bin of saffron. In the U.S., saffron has got to be $100 a gram. I don't know what it is. It's really expensive. Here they have a big bin. It's like selling cloves of garlic or whatever. I don't know what the price was, and I don't read Turkish. But anyway, less of that, more gold. For reference, I saw one Bitcoin kiosk and 100 little gold shops. I'm told that everybody in Turkey, if they had any money at all, would have at least 10 grams of gold, which would be a third of an ounce roughly. And the average person would have a lot more than that. So everybody is into gold there in a way that you just can't even imagine in the West. Um, and logically, it makes sense. They're protecting themselves against currency collapse. Now, the Arab world is different. Now, all three of these worlds have a cultural and religious affinity. Both the Hindu religion and Islam have not only an affinity, but in Islam, there's a religious duty to buy a certain amount of gold.
Mhm.
Um, so, they have that. But in the Arab world, let's say you take UAE, but several other currencies are pegged to the US dollar. And unlike, let's say, Latin America pegs, or even the Chinese yuan peg, those pegs are rock solid, steady, and they've been stable for like many decades. You just look, it's a table flat. It's not like you wake up tomorrow and you think the UAE dirham is at risk of blowing up. It's not. So they're not buying gold to protect themselves against currency collapse. They're buying gold because I think they don't appreciate US monetary policy, but also I think they have a more sophisticated understanding of gold there.
Mm.
They think of gold as a capital asset, not like, my secrets, like Gandalf saying to Frodo, keep it secret, keep it safe. It's a little different there. And it's not that everybody's boasting about their gold, but it's a capital asset and they expect utility from it the way they would a capital asset. And, um, their expectations of what they can do with their gold are greater than, um, let's say in the West. Um, and, there's definitely we don't like not necessarily, they're not hostile to the US as far as I've seen. I mean, to me as an American, they're very friendly, they're welcoming. It's not like there's an anti-American
Mm.
sentiment that's rising. Um, but they don't like the monetary policy. They don't like the dollar necessarily, and gold is a perfect antidote. Now China is a whole different thing. And China, it's not a dollar play, it's a yuan play. They don't like the yuan and they don't trust their own government. And, which spies on them in a myriad of ways. And so if you own gold, they're always looking for ways to get out of the yuan and get out of the Chinese government's, um, cameras and microphones and all that. If you own gold, you have a thing in your pocket. It's not tracked in the same way that a yuan bank account is. And so it's an anti-yuan play, whereas arguably in the other three, well, in India it's an anti-rupee play, in Turkey it's an anti-lira play, but in the Arab world it's an anti-dollar play, I think.
Wow.
And so you have four different things, and they're all buying gold as much as they can. And so in the West, you don't have gold buying, and yet price of gold making a record high. Very interesting
Yeah.
setup and very different from 2012 to 2018. It's not that world at all.
We'll wrap it up with that. But before we do, can you tell us a bit more about monetary metals and what you're up to?
So our whole value proposition is to pay yield on gold. Let people put the gold to work, bring the gold into the market rather than hiding it away, unlocking its productivity, as we say. And pay interest on it. So we have an interest deal right now. It's going to close in a couple of days, but there's always another one, paying 3.5%. That's gold on gold. So you give us 100 ounces, you get 103.5 ounces at the end of the year. And that's what we do. Our website is monetary-metals with a plural with an s.com. My personal blog site is keithweinereconomics.com, and my Twitter is @realkeithweiner, which is KEITHWEI. Unfortunately, there are bad people out there that like to, KIETH or WIENER, whatever, to try to siphon off, whatever brand and recognition that I've created. And then I sometimes I'm known to tweet about controversial topics like Bitcoin.
Yes. Yes, yes, he does. So if you love Bitcoin, head on over to Keith's Twitter account. I'm sure he'll have something for you. But Keith, thank you for coming by the house, and I hope we can do this again soon.
Thanks for having me.
All right, thanks, Keith.
That was Keith Weiner from Monetary Metals, sharing his views on the economy and gold and silver. To follow Keith, visit his website, www.monetary-metals.com. If you like this video, please do subscribe, hit the bell to be notified on updates, and share. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.